Okay, so let's understand the solution from the example first of all. So let's say suppose we have entity like mm, P, Q, and R. So the R deals in clothing, it deals in construction of houses, buildings, etc. And it is the P deals in let's say fitness services. Now what happens to enable the transparency across the financial statements, all types of entity which deal in different types of businesses, services, supplying goods, and all that. So to enable transparency in their financial statement preparation, what happens? There are set of some generally accepted accounting principles which all the entities need to follow. All the entities, all the entities, every entity needs to follow so that their financial statements will be prepared on a uniform basis. And what's what are such standards are called? They are known as GAAP, which stands for generally accepted accounting principles. These are the principles which every entity operating in the business environment need to adhere when preparing financial statements. Now, what such standards or procedures they comprise? Let's understand that, which is very very important. There is principle of consistency. It says every entity should prepare financial statements based on consistent methods. Consistent methods such as, let's say we have example of depreciation, depreciation method, investment valuation, and many others. Now, what happens when an entity follows the principle of consistency, follows the principle of consistency, the entity automatically enables its financial statements over the number of years to be able to get compared by different type of persons like investor, stakeholder, accounting authority, monetary authority, and many more. It enables the an investor or any other person to compare the financial statements which have been prepared on a consistent method. Otherwise, there will be anomaly in the financial statement, and that will be inherent in nature. So now let's move to our next principle under GAAP, principle of accrual. Every entity has to record expenses or revenue, even if not being paid or received. Like principle of accrual says that, let's say, suppose, an example, if X company supply if X company supplies goods to Mr. C of $500, but C has not paid the amount yet, not paid. Now, principle of accrual asks X company just record the revenue even if the amount has not been received. That's all the principle of accrual says. And same in case of expenses also. Let's say suppose Mr. A gives salary. Mr. A is an employee of XN company. Then XN, even if the X has not paid amount which is equivalent to the salary of Mr. A has not been paid, then still the X will be required to record the expense. This is what the principle of accrual says. And last and most important also, principle of going concern. It is just simple as that. But in case of advanced auditing and whereas the auditor will be concerned, such principle will be mostly used in auditor's report. Now, what does the principle of going concern says? Let's understand. Principle of going concern says an entity will be required, not will be required, will be assumed to operate for foreseeable future. That, let's say, suppose we have Z company. So what happens? Z company will be required to prepare the financial statements based on the assumption that it will operate the business foreseeably, that it will not conclude that it will be likely to collapse about in the middle of the life or somewhere in between these 2 points, or these 2 points. So Z and company will prepare the financial statement based on this concept. However, such concept will not be much explainable to you right now, because it is a case of where auditor's report is concerned. So the correct solution for the given problem, for problem 6 is P. Also, one more point I would like to say, that principle of going concern assumption is the most basic assumption, which, however, not anyone will understand, but it will be understood in later cases where we will discuss the profession of audit in terms of accounting, and what the auditors do, and what is the duty and responsibilities of an auditor. So the most important concept is this actually, in understanding the principle of going concern assumption. And it is just that whenever there are adverse circumstances for the company in marketing, in market environment, and the entity is assuming that it will likely to collapse, like, say, let's suppose in 5 to 10 years, and if auditor suspects that aspect also, then auditor will state in his auditor's report that the financial statements of entity are not being prepared on the principle of going concern. This is what the actual real practice followed in the real world. But for the sake of this problem, the correct solution is, for problem 6 is B. Thank you.